Germany, once the powerful economic engine of Europe, has entered an economic crisis, and it doesn't seem to be a temporary situation. The question is, to what extent can Germany jeopardize Europe's prosperity? How serious are its problems? Why are analysts and business people increasingly concerned? What could all this mean for the markets? First, let's put things into context. For years, Germany was known as the economic locomotive of Europe, and rightly so. This country is by far the largest economic power on the old continent, accounting for more than a quarter of the entire GDP of the European Union. To give you an idea, with a GDP of over $4 trillion, Germany's economy is 3 times the size of Spain's. We're talking about a giant, the 4th largest economy in the world, and the major industrial and commercial power of Europe. Here's a fact: nearly 1 in 3 products produced in Europe is made in Germany. 1 in 3 is an extremely high figure, showcasing a huge industrial muscle in a country that is also the world's 2nd largest creditor, only behind Japan. So, it's no surprise that what happens in Germany has a huge influence on the rest of the continent. In fact, we could almost say that Germany is to Europe what the sun is to the solar system. Well, maybe that's an exaggeration, but I think you get my point. Unfortunately, I have bad news. Economists and businesspeople are starting to feel uneasy. They are worried about the economic trajectory of this country. It's time to be concerned about Germany and its economy. The golden age of the German nation might be coming to an end. German entrepreneurs are feeling depressed. Are they worried? Is the German locomotive slowing down? How extensive are the economic problems in this country? And, as we are on this channel, one last question: what could all this mean for businesses and markets? Let's find out. Hello to all the community of Finance for All, welcome to another video. Folks, this economic crisis isn't just a threat. During the 3rd and 4th quarter of 2023, Germany's economy had negative growth rates. Business confidence indices are falling, and investment in the country has plummeted. Economists find it alarming that Germany is not attracting business investment. For instance, in 2023, the country experienced a net outflow of 125 billion euros in foreign investment. Want an example? Take the case of BioNTech, an important biotechnology company. Well, now this company has decided to build its main cancer research center, which is its biggest project, not in Germany but in the United Kingdom. This has set off all the alarms. We are running the risk of progressive deindustrialization. But what exactly is happening in Germany? Why is its economy suddenly showing such negative development? We can identify 4 major problems. First, the high energy prices. This probably comes as no surprise. Germany was very dependent on abundant and relatively cheap energy supplies from Russia. However, with the start of the war in Ukraine, all this changed. Ties with Russia have been severed, and this has caused the energy-intensive German industry to see its costs skyrocket. These costs have increased to the point where many companies have had to halt their production. Additionally, the government has decided to shut down all nuclear plants in the country. The result is that now companies not only face higher energy costs but also expect these costs to remain high in the future. For this reason, many companies are already seeking ways to move their production out of Germany. This explains news like that of May 5, 2023, Germany plans to subsidize energy-intensive industries. The proposal to cover 80% of electricity costs could provoke strong reactions both in Germany and the rest of Europe. Evidently, this would pose serious competition for many companies in other European countries. The second major problem for the German economy has to do with the lack of skilled workers. Despite its economic success, this country is struggling to attract foreign professionals. The rate of skilled immigrant workers received by Australia, Denmark, Canada, and the United Kingdom is 5 to 10 times higher than in Germany. Evidently, fewer skilled workers mean higher costs for companies and also the inability to carry out many projects. If your company needs to attract international talent, Germany is probably not your best destination. The culture, administrative hurdles, taxes, language. The fact is that foreign professionals do not usually prefer Germany as a destination, and that is a serious problem, especially in a country with a shrinking population. But that's not all. The third problem has to do precisely with bureaucracy and high taxes. For a long time, Germany was a reasonably business-friendly country. However, in recent years, high taxes and, perhaps most importantly, increasing bureaucracy are causing many problems for businesses. For example, according to ZEW Mannheim, an economic research center, if we talk about the best place for family businesses, typically small and medium-sized enterprises, to do business, Germany ranks 18th out of 21 industrialized countries. To give you an idea of what this means, almost a third of medium-sized companies in Germany are considering transferring their production and jobs abroad. And note that 1 in 6 is already doing so. It's not just small and medium-sized enterprises, large companies are also feeling the impact of increasing bureaucracy. For example, relatively recently, a law requires all companies in the country with more than 3,000 employees to closely monitor all their suppliers worldwide to ensure they are scrupulously committed to human rights and environmental standards. While this may be laudable, it causes companies a huge headache and adds many costs. To top it off, Germany has become one of the industrialized countries with the highest taxes. We still have one more problem to discuss, specifically the one that is starting to worry German manufacturers and politicians the most. What are we talking about? Let's find out. As you can imagine, China is one of Germany's largest trading partners. For years, major German companies saw the Asian giant as an almost infinite market for their products. For example, over the past decades, giants like Volkswagen Group, Mercedes-Benz, and Bosch, among many others, grew tremendously in China. In fact, for many of these companies, their business in China is fundamental to their financial results, with a large proportion of their profits coming from there. However, this has created two problems. On one hand, as we have discussed here, China's economy is not going through its best moments, which threatens to cool the sales and profits of these companies. On the other hand, these companies are increasingly producing in China for China, thereby reducing the direct benefits that the Chinese market brings to the German economy. This is causing Germany's trade deficit with China to skyrocket. But none of this is the biggest problem. The biggest problem of all has to do with China's growing capacity to compete head-to-head with German products. The automotive industry is a good example. As you all know, this is an absolutely key industry for the German economy, accounting for nearly 15% of the country's GDP. Take a look at this chart. For years, China was a major importer of vehicles, but as you can see, their exports are growing exponentially. According to the consulting firm KPMG, in the coming years, Chinese automotive groups will capture at least 15% of the new vehicle market in Europe. At the speed at which this change is occurring, the final impact could be much greater. Obviously, German companies will be among the most affected. It's not just that they are finding it much harder to sell in China, they are also at risk of losing a significant part of their market at home. For example, Sixt, the largest car rental company in Germany, has agreed to buy 100,000 vehicles from the Chinese giant BYD by 2028. In fact, in 2022, China surpassed Germany as the world's second-largest car exporter. The question many of you might be asking is, what exactly happened to cause this sudden change? The answer is two words: electric cars. For years, Chinese car companies were unable to compete with Western technology, particularly in combustion engines. However, the advent of electric cars has changed everything. It meant starting almost from scratch, and in this area, Chinese companies have been able to compete head-to-head with Western manufacturers. Moreover, China controls the production of almost all the resources and components used to manufacture these vehicles, from lithium to batteries. So now, this paradigm shift is threatening one of the main pillars of the German economy. The Chinese are not only importing fewer cars, but their companies are also gaining market share internationally, and Germany is one of the countries with the most to lose. This is one of the unexpected consequences of the energy transition. Pay close attention to this change. Of course, the automotive industry is just one example, it is by no means the only one. The truth is that in recent years, the German economy seems to have lost attractiveness and agility, and now this is starting to show. But we are on Finance for All, and you know that all this has undoubtedly influenced the German stock market. As you can see, between the years 2019 and 2024, the German DAX 30 barely appreciated by 50%. In comparison, the SP 500 rose by 86.5%. In other words, we are talking about a difference of more than 36 points in the last 5 years. In fact, here on Finance for All, we have already discussed many of the strengths that the US economy has in relation to other markets, particularly those in the old continent. Because as you can see, the German economy does not seem to be going through its best moment. The question is, will German companies be able to correct their course? Are they facing a temporary adjustment or a model crisis? What consequences could all these problems have for the rest of Europe?